The next panel is staking and lending as an enabler of the DeFi industry. So continuing the theme, building on it. The person moderating is the editor of large at The Block. He was actually the first reporter ever appointed to The Block. Before that, he was at Business Insider and NASDAQ. Now, come on, you're not going to guess. This is probably the ultimate little-known fact. His great-great-grandmother's uncle was Pope Pius IX. And so here to pontificate on staking and lending as an enabler of the DeFi industry, please welcome Frank Chaparro.
So we're going to dive a bit deeper into the decentralized finance landscape with three fantastic panelists. Maybe we can just go through. Start with you, Cyrus. Tell us a little bit about SwissBorg, and then we can go down the line real quickly.
Yeah, well, you know, I started my life in private banking, my career started then in hedge funds, and I wanted to make $1 million to be a real millionaire. And then eventually I got into crypto, and I said, let's try to make the real millionaire, that helping 1 million people. And I think this is what we've been doing at SwissBorg, is how to democratize wealth management by making fun, fair, community-centric, based here in Switzerland.
And you're also a millionaire, right?
And yeah, as well.
David?
Hi, I'm David Olsson. I'm the global head of prime financing and OTC sales at Kraken. For those of you that don't know about Kraken, we're a global digital asset exchange operating in 200 countries with 11 million registered customers. We have not only a spot exchange, but also an FCA-authorized futures exchange, staking products, and a world-class OTC desk.
I'm Diogo, Mónica, co-founder and president of Anchorage Digital. Anchorage is the first and still the only federally chartered bank in the United States. So as everybody talks about regulation, it turns out that there's actually one bank that is regulated by the OCC that does custody, trading, staking, lots of participation in crypto protocols. And so if you're looking for any of that, I'm here.
Until the block gets our OCC charter, which is imminent, I hear.
They're going for it.
So what's really unique about these three gentlemen is they are not DeFi providers themselves necessarily. They're not DeFi platforms, but they're sitting in between the decentralized landscape as well as sort of a wide range of investors who are trying to tap into that ecosystem. What's the sentiment right now? Have you noticed a pullback of interest in terms of some of the topics we're going to talk about today, decentralized lending, staking? What's the general sense you're getting from clients, Diogo?
So the most important thing is that one of the main reasons why people were excited about DeFi was the yield generation opportunities. Right now, if you've noticed, yield generation opportunities in DeFi are actually lower than treasury opportunities of generation. And so if a risk-free asset gives you 5%, you are not going to put on something that generates 4% on a DeFi protocol. So just that obviously reduced and took a lot of the air out of the ecosystem. But despite that, one of the things that we see is lots of institutions actually enabling products and integrating with DeFi in general, but the generic Web3 group of ecosystems, and those types of projects continue marching forward. So there's lots of publicly traded companies in the US that come to us that really want to be able to participate in X protocol, say a very large naming registrar that wants to participate in Namebase or one of these protocols that does naming, or a very large cloud computing company that wants to use Filecoin or some of these other protocols to really expand into the elements of DeFi that allow you to kind of like integrate into that side of the world. So those continue happening. The financial aspects of DeFi that were just depending on yield have dried up.
Well, yield is the most important thing for an investor, right? But what we probably lost sight of in 2022 is that yield, to a large degree, is tantamount to risk, right? And so with the clients with whom you're speaking, are they wary of the yield, even though it is lower than treasuries? Is it still something that scares them, maybe with staking specifically?
Yeah, so I always think is that if you don't understand where the yield is coming from, you're the yield. That's the common practice, okay? It is what it is. And maybe quick question for the public. Who is staking or yielding here?
Nice. Don't lie, though.
Okay, that's like 1/3.
Okay.
What we always been trying to do at SwissBorg is to bring transparency, because we know that that's one of the big stake and at least one of the big philosophy behind crypto. And I think so what we always try to educate as well our user base is that one yield does not fit everyone, because you really have to have essentially understand what's the underlying risk that goes from multiple different layers that we could talk about right after. But what we always try to put at SwissBorg is that each user, depending on his profile, he should be able to look at where the yield is coming from and understand if this is a risky or non-risky type of return. So that's how we always done that. So we have different risk metrics that enable people to stake in, let's say, for example, an AVE, which is more a AAA type of risk, down to a Stargate, which is a platform of DeFi that's giving lend and yield that has maybe a higher risk. So this is really how we try to, let the user understand where the yield is coming from and let them educate them to make them take the decision to take the risk and therefore get the right reward for them.
David, you guys are ramping up your institutional client services across OTC, as you mentioned. I imagine staking to an extent as well. You've been in that business for a while, one of the first, right? How do you explain to a high net worth client or an institution where the yield is coming from as it pertains to staking and what the risk is? Do they gronk it? Is it something that's sort of a slow stream of interest?
I think that was one of the big surprises for me, was that that I saw, and this was probably started a couple years ago, but has accelerated. Especially credit managers are incredibly interested in crypto for that reason, because there's such a thriving DeFi yield ecosystem. And so they view it as something that they need to be on top of and a part of. And in terms of staking, how do I explain where the yield comes from? To a certain extent, it's the central bank of each individual currency. So, but instead of being run by a board of governors, it's run by code. And so there's basically a risk-free rate that gets set that is a reward for people participating in the ecosystem, and that's programmatically then deployed to stakers into the ecosystem to help it grow and be sustained. So that's sort of baseline, and I think that if you look, for example, at ETH2, which has a staking yield of something like 5%, then you can all of your other financial instruments then get referenced back to that. So would I ever lend out my ETH for less than 5%? No, because I can stake it and get 5%. Would I write a forward contract and not bake that rate in? No, I would, because I can have that opportunity cost or time value money. So I think it's actually a great innovation, and at Kraken we truly believe that our mission isn't to maximize profits, it's to maximize the spread of crypto around the world. And staking is definitely a core part of that.
Diogo, I think I have two questions for you.
Only two?
If that's okay. Just in this instance.
Let's do it.
As a sort of centralized counterparty sitting...
Not sort of, fully centralized.
Fully, okay. I was giving you the benefit of the doubt there.
No.
And regulated. What is the benefit of someone coming through an Anchorage to tap into staking? And how do you sort of deal with the backdrop of a macro environment in which yields elsewhere are increasing? I imagine that certain investors would be keen to look elsewhere. So those two questions, how would you unpack them?
Yeah, so maybe I'll start with the latter one. The latter one is, of course, if you're yield chasing, there's many other opportunities for you that are available. One of the advantages of us being a bank is that we actually get to do banking businesses too, right? And so to a large extent, I think it becomes easy for us to also offer the other side of the house in terms of products. But the yield on DeFi definitely is not there. And so to answer the first question, I think the reason why we need to exist is manifold, but I think the two biggest ones. Number one, many institutions in the United States are mandated by law to use us. That's a pretty good reason. In the United States, if you're a registered investor advisor or many other designations, you are forced by law to use a qualified custodian, a third-party qualified custodian. You cannot do self-custody, cannot hold your own assets, and it needs to be at a qualified custodian. And there's a set of designations for what a qualified custodian is, but one of them is obviously being an OCC chartered bank, so a federal bank. And so the answer to your question on the first stop is many institutions are required by law to use a qualified custodian, and so they have to use someone like us. Someone like us needs to exist for them to be able to come into crypto. The second reason is that turns out that the centralization, so we were making this joke about centralization, right? So you're not, the benefit of the doubt with the implication that somehow a centralized entity is bad. But note that for other centralized companies, the use of another centralized third party, there's a specialist in security and a regulated specialist in security, is actually how they do all of their business already. And so for them, that's actually what they're looking for. They're not looking for a decentralized version for anything that they're doing. No, they're looking for the exact same type of relationship, the exact same type of insurance, the exact same type of market structure, the same exact type of risk management that they have from their other counterparty. And so what I see in Anchorage Digital is we are the bridge between traditional financial institutions, because we're a bank, we look exactly like JP Morgan Chase, it's the same charter, and the world of DeFi, because we do have the technology to integrate with all of these public ledgers and all of these public blockchains. And we're not just doing custody, we're doing the governances, you can participate in DeFi protocols. So really is necessary, because 80% of the market, if we succeed, is not gonna be at the edges outside of traditional finance industry. No, if we succeed, 80% of the market in DeFi will be participated by the large financial institutions in the first place. So we need to be there to allow them to come in a safe, regulated, and easy manner.
But you don't see them maybe more interested in alternative investment opportunities aside from staking, given the rate environment?
So many of them actually, yes, for the investment in staking, but there's many reasons why you do staking. One of the main reasons why you do staking is because you have a long position in this particular crypto asset and you're looking for the risk-free interest rate, like was just described, right? And so you have to stake. And by the way, many of them have the ethos of, I am investing in an early stage protocol and I want the protocol to succeed. And the best way for you to have the protocol to succeed is to help with the decentralization aspects in the safety of the network. And in proof of stake, one of the ways that you do that is you stake on the network. And so many of them are actually there for the right reasons, for the ethos to participate, to be able to participate in the ecosystem.
Versus chasing yield.
Exactly. Yeah, I think so. I think so. What we always have to understand is that if we're investing just for the sake of the money, we might unfortunately fall into something that we don't understand. If you're now staking Ether or you're staking Filecoin, or just really believing that the fact that this protocol, this application is going to make a great change, well, therefore, all these users are going to stake regardless whatever the price movement's going to happen, and they're going to participate for the future of this project. So I think so from our end is a bit similar. Obviously, if at SwissBorg, we were one of the first retail platforms to give exposure to DeFi to a fair amount of users. And in the beginning with Aave, Compound, and all these beautiful different decentralized financial protocols, you would get 44%. So
I miss those days.
Yeah, I miss those days. But today you're getting like 1 to 2 to 3 to 4% at the maximum at SwissBorg right now with USDC. So that definitely gives a big changer. But if you're doing this now with Ethereum and doing this staking in the protocol or doing it through Lido or whatsoever, then you're already a strong believer about buying that token. So why not participate in the future of it by staking it and getting a yield on top of it?
One thing that I think investors are looking for are guarantees around risk or safeguards. What benefits does a person like that have in engaging with a centralized counterparty to tap into DeFi? Are there protections around getting slashed, David, or other types of protections or insurances, to Diogo's point?
Yeah, I think when investors are, especially when they're first dipping their toes in the water in terms of crypto, they really need a trusted party to engage with. And those things mean that unlike, and I think DeFi has a great place in the ecosystem. We really believe that at Kraken, but there's also a place for being able to have human interaction. We take clients, we hold them by the hand, we educate them on the space. They can make informed decisions on how to invest, and also highlight the risks to them of what that investment is. So for staking, for example, there is slashing risk. That's if the node operator doesn't validate transactions correctly, then there's the potential to get your principal reduced as a penalty for not validating the transaction correctly. So centralized platforms can insulate you against that risk because we will put our own capital on the line before our clients get slashed. There are some, some insurance pools and other types of mechanisms to do this, but the reality is, if you're operating really in the deep end of DeFi, you may not have those assurances. So I think those are the things, and I think it's going to be a long time before people go to zero human interaction when they make significant investment decisions.
To go back on that, I have a good analogy, because I always try to surf by myself. So I'm quite a sporty person, so I said I'll make it easy in surfing. I never took an instructor. I got wrecked. I blew up like boards. I did really bad, because I thought that myself alone and looking some YouTube videos, I'd become an expert surfer. DeFi is the same shit, pretty much. you could look at a lot of influencers and how things are being done. If you don't really have an appetite for a person or a really good team of auditors that look at the whole technology, financial controllers that understand the token economy, liquidation practice, if you don't have teams that make sure that the oracles are updated whenever there's an update on a chain, and you go on and on and on, you really do have to look for this whole competency before being an expert. And I'm sure a lot of people in this room could do this, but I'm pretty sure that 99% of the planet doesn't have the time, the money, or just the drive to do that. So I think you will always have some hybrids, if we could call it hybrid models, that we have between CeFi and DeFi that could help, I think, the next billion people to get into DeFi.
Well, that's what all three of you on this stage embody, is this hybrid model, as it were. Can you peel back the sort of regulatory angle of this when you are maybe enabling new types of DeFi services or providing access to different arenas of the decentralized landscape? You have this charter. Do you have the mandate to sort of go into all sorts of different arenas? And what questions maybe are regulators asking about staking, et cetera?
So extremely complex, and it actually varies on a per asset basis. So if you really want specific answers, we would have to get a lot more precise.
We have the bubble later.
Right,
so
bubble. So basically,
bubble.
like, you could ask Diogo, how do I do DeFi on Solana with this particular type of parameters, with this amount and this type of asset? All of those things actually yield slightly different answers, no pun intended on yield. However, one of the things that I have to say is, first, remember, many of these institutions must use a regulated party, period. They don't have a choice. So when they want to participate in DeFi in the first place, they need to have it somewhere that is regulated. So that's obviously a big part of it. The second component here is, if we talk about staking for a little bit, our charter, our federal charter, actually says that one of the things that we do is staking. So it's under the charter itself. So when an institution comes to Anchorage, they see that one of the services that we offer is custody, the other service that we offer within the charter is staking. And so it's basically, they know that it's under the same umbrella of scrutiny and oversight from the biggest regulator, banking regulator in the US, which is the OCC, that both of these activities are actually being done. And that brings you confidence, which is another thing that institutions are looking for, is this confidence that this thing is actually going to work. This is the positive version of it. The bad version of it is the CYA, right? Cover your ass type mentality of like, oh no, these people are legit, they're a bank, and so if something goes wrong, I don't want to do this myself. So those are our two aspects that are worth mentioning. And so one of it is that you're required to do it from an entity that is regulated in the first place. The second one is that, yes, our charter does allow staking, and so it's explicit. And then when it comes to DeFi, you still need accounting. You still need bank level accounting. Where are these things? Are they staked? Where are they going to be returned to? Where are they held? And those conversations are extremely hard. And finally, to the point of the regulators understanding, I think they are definitely the staff at these many regulators. The staff has now deep levels of understanding of what's happening. They ask me deep questions about staking. They actually ask me questions about different types of staking of different networks. So they know that some networks have something called tombstoning or slashing. And they ask me, oh, this network is one that has slashing. Are you taking any risk? So these are complex conversations that are insightful from the regulator's point of view.
Have they stumped you yet?
What was that?
Have they stumped you?
Stopped us or
stumped on a question?
Oh, they are constantly making questions. They have stumped us in terms of complexity and understanding now all the time. When you get to DeFi, the fun part is that I'm sure that people in this audience have many different tastes in DeFi protocols, and I'm sure you can get questions from me that I don't know how to answer. a person with a PhD in distributed systems and security that has been working in crypto full-time for the past over 6 years. And I will not be able to answer them in the first place. So there is no hope for a regulator to be able to do so. So we also have to make sure to understand that their role is extremely hard and that the space is moving so fast that is extremely hard, especially on the DeFi side, that things are so complex. Just simple questions of where are the assets? Oh, they're on the smart contract. And they have a return address that is actually at X address, but they're not actually held by me. That's very hard. Those conversations are hard.
Let's pivot to something that is my favorite topic, very near and dear to my heart, the 2022 crypto credit crisis, which kept me up late into the evening. Oh, it was bad. Gained 20 pounds. It was a mess.
Tell us all about it.
Well, so it all traces back to Terra Luna melting down, I would say, then 3AC melting down, and then the sort of dominoes continue to fall. David, you were in the trenches, as it were, at BlockFi. What lessons have we learned? Was it an issue of collateral? Was it an issue of chasing our competition? What have we learned, or what have you?
Yeah, I mean, I think it's a really long list, and probably take up the rest of the time of
we actually have an extra 15 minutes.
Okay, so
just for lessons.
And I think a lot of them have already sort of been covered. As I think it was a combination for me personally, in sitting in like a risk sort of, even though I was on the sales side, being in a kind of risk-bearing role. I think the two main things, and Cyrus already touched on one, is that you need to describe to your clients exactly what they're, just like you do in traditional asset management. When someone invests into an Argentinian bond fund or an emerging market bond fund, it says emerging market bond fund, like on the tin, like that's what it does.
And it gives you a rating.
Right, and they'll say these are the bonds ratings that some are unrated, up to 40% unrated. They'll have portfolio limits, all these things. I think like the same thing needs to be done in crypto, where every risk bucket needs to be clearly identified for clients, and that's somewhat of a regulatory thing to just bring it in line to what can be offered to retail, what can be offered to MiFID professionals, or as we call them in the U.S., to accredited or QPs, and so that's like I think that's like lesson number one, and lesson number two is that the risk of something changes over time. Just because GBTC was really liquid a year ago doesn't mean that GBTC is going to be liquid a year from now. And so the risk that you might be taking on your loan book, or even Bitcoin or ETH for that matter, changes day to day. Changes much faster in crypto than it does in traditional like equities or those types of markets where you see financing. And so you really need to be dynamic with your risk management. Another lesson is just in terms of credit risk is that, and when I came into Kraken to build the prime business, and I've only been there for a few months, but the first thing I said is we won't be taking unsecured risk because we don't have the tools to actually properly manage and assess the credit risk to our counterparties. There's some things out there that are interesting, like Nansen or Credora, but none of them really can capture all the risks. Until we have that ability, you're not going to see that come back into the market.
I would also add, right, that, and someone said this on Twitter, so this isn't my own independent thought. I don't have many of them. But you're taking an asset which, in its essence, has the benefit of its transparency on-chain, but is also volatile. That's the other side of the proverbial coin. And you're bringing it into a capital market system that, by its very nature, is opaque. And that gives you a recipe for a credit crisis.
It's even worse, actually. I think one of the things that we rely on traditional finance is actually the diversification aspects of the counterparties themselves. Since there's more counterparties and there's more risk out there, you end up not having pooled risk. And in fact, there's a lot of rules and regulations that make you give enough data so that you can actually judge what other people's positions are at other prime brokers. None of that exists in crypto, and it's all the same people. And so not only this, there was very little.
It was one firm, 3AC.
And it was asking loans from everyone, and everybody had that collateral counterparty. And then those people were actually using the arbitrage trade from these other people that were also owning a company that also did loans to the same. So it's a little bit of a cycle here. There's loops because there's lack of diversification because there was not that many institutions in crypto.
Yeah.
And just to get back to the basics, like if you want to run the strategy arbitrage, you set up a fund, and then you don't get like a 10% yield. You get the performance of the fund. And I think so. This is where I think so. A lot of things in crypto, we're obviously trying to innovate in some ways. But we always have to go back to basics and understand what has been done extremely well from the TradFi and how you could bring it on chain and make it just better. But you cannot break the whole rules from the TradFi. And I think so the three of us agree there that this is exactly what we're trying to do, right? Is that you take what was in asset management, what was in banking, and then power it with the beautiful spices of crypto, I think so.
So that dovetails great into what I was going to ask next, which is there a future in 2023 and beyond for crypto's capital markets in which you have the centralized lenders, so reimagined genesises, if you will, with a DeFi underpinning where all the lending is mostly happening on chain and they're sort of just sitting in between that?
So something to make note of is one of the biggest handicaps of DeFi right now is the fact that they're exclusively over-collateralized loans, which are known to be extremely capital inefficient, which is part of the reason why the yields are so low too. And so if you have this tool that is great, it's transparent, it allows you to do over-collateralized loans, LTVs of 50% or what have you, that's all fantastic and great. However, it is not capital efficiency. And we know that one of the things that's going to happen invariably in traditional finance and any finance is going to be the search, the unrelenting search for capital efficiency and being able to squeeze more dollars. So one of the things that is going to happen, and it's already started to happen, and we were talking about this in the back room, is the fact that DeFi has to innovate out of just over-collateralized. And so there's many different ways.
How does that happen? You're gonna go ahead.
So there's a couple of companies that are trying to do it, but the general concept is the following. It's effectively the same thing, underwriting. How do you do underwriting? How do you underwrite it on DeFi? And it turns out that the first thing you need to underwrite on DeFi is identity. And once you have identity, you can tie credentialing, a Twitter account or a Lens protocol account, more specifically. It's a decentralized account that if it has 300,000 followers, that person is standing by. If they default on a loan, that account is going to be known for
forever.
Having defaulted on a loan. So those 300,000 followers of that account.
You could repossess the followers, maybe.
You can repossess the account, you could sell whatever it is, but it's reputation that is on the line, which is not the same case when it's just a public arbitrary private key. So these are the things, the steps that are being done. We create identity, we put in reputation, maybe history of transactions on other DeFi protocols, maybe other assets of where they are, maybe KYC'd identity to make sure that this person actually has a real job and actually has a stream of income, or the company has a stream of income. And then the bundle of that is the thing that gets underwritten automatically by the DeFi protocol. This is possible.
Is there a way to extract the actual identity of the person from their, let's say, DeFi social credit score, as it were?
That's exactly what I think. So we were saying earlier is that I'm not sure, Stani, you're not in the room now, but I imagine some of the interest of Stani with Aave, which is amazing, one of the best DeFi tool, the only AAA, let's say, one of the only AAA DeFi protocol. Why Lens protocol could be such a great way is that, again, what we were saying earlier is if you start having really a lot of activity on chain with LensTube, with Lenster, and all these different social media, and you're starting to now, you want to buy a car, so you're going to deposit whatever, some amount of Ether, and you're maybe going to go uncollateralized borrowing, you're probably going to do this in a good way. Because if you don't do this in a good way, well, then maybe this, whatever, Aave is going to send you a Soulball token to this address saying, now you are a bad payer, right? And then everyone's going to see that on social media eventually, and your account is going to be pretty much compromised. So obviously, this is not the best thing for how identity could be perceived, but at the same time, it could be a very meritocratic one, because if you do the things right, well, then you'll probably get a better LTV or a better borrowing rate.
Yeah, I think it's both really good points for kind of retail-oriented products. And I think, like, if you look at credit scoring and credit cards and auto loans, there's hundreds of thousands of data points, consumers, and they can write basically an AI underwriting machine that can do that very effectively. I think institutional business is different. I think there needs to be a lot of hand-holding and like human intelligence around it in terms of divining what are the people doing on the other side, and how do they conduct their business. And there's a lot of just red flags, things that are outside the world of like pure kind of protocol and computational power can decipher. So obviously I'm biased because I'm sitting in the seat of some of doing prime finance for crypto institutions. But I think that's going to be the way it is for even 30 years from now, even if we have the next 15 generations of ChatGPT.
So going back to the first question, do you see, like in your strategy at Kraken, is there a potential for you to be drawing upon an Aave or a Compound as you lend out through your prime finance business?
I think so I do think there is a model where you could have a two-speed solution where we could do certain lending for our clients on balance sheet, on exchange. And then if there are risks that we're not comfortable as an institution taking, we could participate in a DeFi protocol. Unfortunately, a lot of the ones that were unsecured have had some bumps in the road. But there will be others that evolve, and I think there was a barbell in DeFi lending. It was like super safe AAA, Aave Compound, or you had extremely risky unsecured, and there's nothing in between. So at some point there will be something intelligent that comes up that is in the middle.
And one of the things that I have not seen done, but for institutions, a lot easier to do than retail. And part of the reason why we started with retail is because it's this strictly harder problem. For institutions, actually, it becomes somewhat easy for you to imagine for a moment that you trust Anchorage Digital. You could actually allow us to say, we're not going to disclose your position, but we're going to become an oracle for the dollar equivalent of your position on chain. And you click a button, and now we're publishing your total position on chain towards DeFi. And that is the signal that gets to be used by the distributor, by the actual smart contract to decide whether to give you a loan or not. And so for institutions, it's easier because there's other assets, there's income, there's dollar flow. And so we can actually attest as third parties that exists. And as long as you trust a set of oracles that are either external third-party auditors like the Big Four or whatever, or the actual custodians that do see the assets in the first place, I can tell you that I'm not going to do an over-collateralized loan, so I'm not going to put $2 of Bitcoin for every dollar that I'm going to borrow, but I'm going to put $1 of Bitcoin, and I'm going to put an attestation from Anchorage that I actually have 7 more. That now becomes a different picture of underwriting, because I trust Anchorage to be an independent third party to inject that this counterparty actually has other assets. So things like that, I have not seen done, by the way, but are likely to be the path forward on how to underwrite here.
Let's sort of look at the scoreboard, as it were. We look at the drawbacks of decentralized lending. It's not capital efficient. Benefit, though, it's transparent. Risk, technical risk. Yep. Centralized lending, risk, counterparty risk, clearly. Benefit, more capital efficient. Yes. I mean, they'll give a loan to anybody, or they did. And then the other drawback maybe would be the opacity of it. Is that fair? Would you add anything or subtract anything to that?
I would say to add on top of that is, I think so for DeFi and lending is, I think so the more and more is how to go for real use cases. Because until today, a lot of lending, borrowing is happening on DeFi is essentially to get leverage.
To buy more coins.
To buy more coins, to get more staking, to get more rewards. And that's cool for traders. That's not cool for the planet. That doesn't really help any much in the planet. So I think so that's where we're going to see more and more different protocols. There's already some of them did good, some of them are in difficult positions right now. But I think so this is where I think so we're going to see more and more really cool different protocols that are going to bring in a good way to understand how the real economy works and put it into DeFi.
Joe Weisenthal brings this up all the time, that DeFi is just a closed loop of people borrowing to buy more coins and then levering up and levering up and levering up. How do we break it outside so that factories are built with DeFi or office buildings?
It's got to be permission. I know it's such a dirty word, but permission DeFi, 2 words, permission DeFi. It has to happen. Because there's way more permission capital than unpermission capital.
And to that point, one of the things that you didn't mention that is actually the most important thing that drives people to do centralized lending is because it is the thing they know how to do. They don't need to figure out anything. They've done it a million times. It's the same quote-unquote API that they do with normal lending for some other asset. They already are super used to putting their equity on the line or their cash flow on the line or their houses on the line as actual collateral. And now they're just putting crypto on the line, but it's another institution. It's the same type of contracts, the same lawyers that you use. And now for DeFi, you're not using lawyers, you're using computer scientists and security professionals. You're using people that are inspecting on chain. So all of this is different. So it's so much easier to do in centralized world. And it's almost more capital efficient that until those things are actually solved, that will always be the easiest path.
Okay, well, if you guys disagree with Diogo, you can find us in the bubble at a certain point in time.
We already have some takers.
Thank you. Thank you.
Awesome. Thank you. Absolutely terrific.